Welcome into today's video. I'm going to be talking about my biggest investing mistakes and what I've learned from them. Why should you listen to me? Well, I've got 6 years investing experience investing my own personal money. If that's not enough for you, click away. That's fine with me. So what I'm going to be talking about here is the biggest investing mistakes I've had and how I've learned from them. And I think it's sort of what I've realized as I've started maturing as an investor. So for me personally, it's about knowing yourself. I mean, if you sort of listen to or read sort of the Art of War, the book by the Chinese strategist Sun Tzu, he sort of mentions the fact that to know the enemy and know yourself, you need not fear the result of 100 battles, something like that. I'm paraphrasing. Anyway, the point here is I feel that as I've started to understand myself better as an investor, reflected on the mistakes I've made and where I've gone wrong along the way, I've started to become more aware of that and then able to pick that up and catch it and prevent it from occurring the next time in advance. And that's something that saved me quite a bit. So for me specifically, again, this will depend person by person. I have a tendency to be really optimistic, which is good. I mean, an investor generally, if you're long equities, you want to be somewhat optimistic. But I think where I fall flat is that I I always subconsciously had discounted the negative element of a risk. And what I mean by that is that what would happen is I would see these fast growing companies and I'd see that their net income, that their business is still unprofitable, but I would see that, their loss ratio year on year is improving, meaning they're becoming more and more close to profitability. Their gross margins are increasing, they're becoming less and less unprofitable every year. And eventually, in my perfect world brain, that, expects that to continue 5 years into advance, thinks that this business will reach profitability and then they should trade at this ideal multiple, and then you get to this end value, right? But that's not always the case, and there's a lot of things that can go wrong there. And so my general evolution has been to understand that, look, David, you tend to be a bit over optimistic on certain things. Now, obviously, as I've become aware of that and as I've implemented that, that slowly started to fade. And generally now I understand that, look, there's a lot of things that can go wrong. Yes, more likely than not, if they've got good management, if they've got good systems in place, if they've got the right experience, the right value proposition, I don't see why that should stop them from growing there. If the market opportunity is there, I don't see what would stop them. But I also need to take into account, well, there's many things that could go wrong, and why invest in things which you're taking unnecessary risk on, whereas you might be able to find something a bit more boring on the surface which actually has as attractive of a return, if not better, with the same amount of risk. So for me, I've started mentally taking note of that, and a few things I've started to do is, I've got a checklist. So in that checklist, that's a big factor for me, that's something I take into account. A general rule where I generally massively, so in my head, if I come across any unprofitable company, massively discounted, and I'm generally only focused on profitable businesses. And that's something that, is a rule that's set for myself. But also researching and studying on the topic, reflecting on my more successful positions have pretty much always been profitable businesses which have continued their growth. And, just studying research reports as well, where they've often mentioned that the likes of small caps outperform in terms of multi-bagger performance. They start off with nano small caps. But another thing is that actually a lot of these companies start off profitable. So it doesn't mean that you need to speculate on the transition from unprofitable to profitable. Now, that you can make money doing that, of course, but there are better ways to do it for me, and that's something I've stuck to. And I guess another thing that's sort of tied with this risk is the fact that something I've not realized, which I've again reflected on down the road, is that actually risks are a lot more correlated than you think, David. And what I mean by that is that I've had it where I've had three unprofitable, fast growing companies, all in different industries, all very good businesses, and a fair amount of them did become profitable. Like I invested in Uber pre-profitability, and look, it did become profitable. You would have done really well holding that company. Palantir was another one. But for me, I think what I didn't realize is that these businesses can be a lot more correlated, and it's even because they're in different industries. So a good example is interest rates. Interest rates affect everyone, and that means that these companies which are losing a lot of money, which rely on cheap money sloshing about in the system to fund their expansion, as well as any loans and debt, but just also investors, money being cheaper makes it easily accessible for these unprofitable companies to receive funding at attractive valuations, which they normally wouldn't get otherwise. That significantly impacts their ability to get funding. So there are multiple ways these can be impacted. Another sort of correlated risk that I want to perceived is that if a business has a high amount of sort of debt on its balance sheet, any significant rate increase in interest rates is going to significantly impact the business. So that's something I didn't realize with all these businesses being so correlated. So now I have to take into account individually on its own merits, how safe is this business? What are the merits this business has? So it could just be that it has a very high margin of safety in terms of its balance sheet. Cash could exceed liabilities and make up a good fair share of its market cap, including any hard liquid assets which you'd actually be able to sell in the event of bankruptcy. I'm not just talking about net operating losses which disappear into thin air as soon as the business goes bankrupt. They're not worth anything. So they're like the two main things that I use, and ways I've sort of implemented that is by A, having a checklist, B, reflecting on my investment decisions and positions and what's done better, what's been my top performers, what's generally been my lowest performers, if I can categorize them and why. Number three has just been being honest with myself and seeing where have I been messing up, what have I been missing, or just what have I misunderstood. And I think it's being able to do those three in conjunction. So yes, I'm being honest with myself, but I'm also giving myself the opportunity to reflect, and then I'm actually implementing it going forward. So any position that, I've set myself this rule, unprofitable companies generally a very hard no. And then I've also got a checklist to follow up for that and sort of spot any mistakes, but also writing on that checklist. I've overshot in this type of area. That's typically been a blind spot for me, and just being aware of that, having that wrote down, having a system and a checklist, a step in a process to prevent that from reoccurring. And that's generally helped me out significantly. Everyone's going to have their own blind spots. Some people, I give an example with a famous investor, Monish Pabrai. He's often said that to his detriment, he's unable to pay up for his great businesses. So what that means is that, market might trade at 18, 20 times earnings on average. Monish Pabrai is stuck looking for those companies at a price earnings of 3, 2, 3, 4, 1 times earnings, which can be great, don't get me wrong. If you find a good business at 1, 2 times earnings, 3 times earnings, you're going to do amazing on that. But what's happened is when he's seen businesses that he knows are exceptional, like a good example is Meta. He knew Meta was exceptional at $80 a share. He still was reluctant to buy it because he just couldn't pay anything, anything at a double-digit valuation, even though he knew it was a great business, great moat, sustainable growth, huge discount to what it should really be trading at, a strong balance sheet and everything. He just couldn't pay the 10, 12, 14 times earnings, whatever it fell to at the peak, at the trough. And he even said that it's probably a great opportunity and it's probably a mistake to miss it. And if you look at Meta today, 3 years later, it's at, 600. I've not looked at it recently, but $500-600 a share. That's it's almost an 8x, which has pretty much outperformed every position he's had since that period. And yet he's publicly gone on record saying that saying it would have been a good position for him, and that's his flaw, and that's something he's acknowledged, and that's something that I've noticed in his content actually that he's started pivoting towards, which is finding great businesses and just holding on to them, even if it's very rare once in a blue moon that he buys them. He's just going to hold on to them, identify it, and just hold on to it. And you can really see that he's transitioned and done this with the likes of Resos Technologies. Yes, it's a Turkish company that effectively have multiple segments, but the two main things is that one, very savvy capital allocators. They're generally anything they invest in, they want a 3-year payback period, very smart allocators. and secondly, the industry they're in, because of Turkish devaluation of currency, they actually get an inflation. They actually get headwinds tailwinds because of it, because the land itself and the buildings itself go up in line with inflation, but the buildings costs and materials they put into it actually go down as a percentage. So overall, they actually get these tailwinds from the fact that this disruption is occurring in Turkey. And what that means is that their return on it, what happens is that at one point, Mercedes dealership that they built, they got the cost to build that dealership, they got back in a year's rent from Mercedes alone. And that's because of this dynamic occurrence, a really attractive return on capital there in that segment. And he's been able to hold on to that business. Admittedly, he did still buy that at dirt cheap valuation, but even then, it still made sense for him to hold on. He's still been holding it as it's appreciated considerably since. Thanks for listening.